Find a power user. If you don't have any power users, your solution doesn't really solve a problem.
$5, $10, $20 a month subscription.
And adding features for the wrong customer is very troublesome.
The American population is going to realistically sign up, afford, and stay a customer for the lifetime.
Don't look at solution B until your growth rate on your primary product has slowed down.
Investor pressure forces founders to make decisions.
You don't like that pushback, don't take money from them.
Most awkward interaction or pitch with a founder.
You're better off going to another investor and finding somebody. And it's a hard thing.
Hey guys, welcome back, friends and founders. Today we have on Jeff. Jeff had an early career as a design engineer and a director of silicon engineering. He had a couple CXO roles, CEO at Omni Base Logic, CFO, CEO, COO at Nexursis, also known as XFit Inc. He played various finance executive roles, VP of Finance at Graviton, which I think was an IBM company, Fractional CFO, CFO at Longview Equity LLC for a couple years. Currently, he is a fractional CFO at Merante Growth. He's the co-founder and a GP at Longview Tech Ventures, and he's also the author of the book showcased here, Fooled by Early Adopters. Welcome to the show.
Thanks.
I wanted to start off by asking you, what do you think product market fit is? And I ask because you've written a book about product market fit, but
that's a great starting question because I have a book about product market fit.
But let's start there and then we'll I have some follow-ups from.
So I think of product market fit on a continuum. And so I think we've talked about this, that you start off with match, what I call product market match, which used to be referred to as table stakes, which means I have to have a minimum solution in there that is as good as everybody else. And so that's like the first step. And then once you go from match, you can go to alignment. And that's where, customers are considering you as part of the solution to their problem. So you have alignment with their problem. And then product market fit, I think of as what was referred to back in the 90s as being inside the tornado. And so that's like when Mark Andreessen says you can't buy servers fast enough, you can't hire salespeople fast enough, and things are just going crazy. And so there's a common saying that if you're asking whether or not you have product market fit, you don't have product market fit, because product market fit is crazy.
So 2 follow-ups there. If you can't grow fast enough, if you can't hire people, you can't scale, there's obvious bottlenecks because there's so much demand. Do you think there's a place for a product, a solution, a SaaS company where maybe they have a really good solution, they have really good fit to the industry and the customer they're solving, but it doesn't necessarily mean that, there's sales flying out the door and there's growth flying out the door? Are there those situations that exist? And the reason I ask is I think there's a place for SaaS products to exist that are not your unicorn SaaS products. Not everything has to have 100 million ARR, 200 million ARR.
Yeah.
But they still probably solve a problem really well, fit in really well to answer that fit into the first half of your definition of PMF.
Yeah.
Do you think there's a space for that, or?
No, I think every company goes across that continuum at different stages of life. Like I would make the argument that Uber doesn't have product market fit. Uber has alignment. So when I think about I need to call a car, I think of Uber.
Yeah.
And so they're aligned with, in my mind, that solution.
Yeah.
Right. But Uber doesn't really make money. And they're not, it's not in a situation where, one person gets out of an Uber and another person gets in.
Yeah.
They're not that locked into the market in that it's crazy and they can't hire enough. I think they do have issues hiring drivers, but I don't think they're at a space where, they're essentially inside the tornado, which is what Jeffrey Moore called it. I think that the Uber is a long tail type investment, and that the product market fit for Uber is when we have driverless vehicles. And so that's when they don't have to pay the driver, and they can really leverage the fact that they kind of own the mind share of the consumer. And so that's when I think we're going to see Uber having product market fit. But I agree. I think that, there's along that continuum, you could have a very successful business at match, and you can have a very successful business at alignment, and not everybody's going to get to this kind of panacea of fit.
I like that you made the Uber example. I think what they've done really well is made a name for a problem that exists. People refer to, hey, let's Uber there, not let's grab a taxi there, not let's find a ride there. It's become a connotation. And I think, like you said, mindshare is very important. And you get to the point where you will reach some sort of fit. I don't know when that is, what the turning point will be, but Uber is a good example because they've captured the mindshare. Even if I'm taking a Lyft, people will refer to that like, hey, let's find an Uber there. And then I'll open an app and figure out which app do I want to do. But the connotation of taking the action, now everyone else is always going to be a step behind because first market share is always going to be.
Right. And that could have been the taxi industry, right? But they stuck where they were, and they didn't take advantage of the technology that was available. And now Uber's defined that new space.
Yeah. I don't know what they do with 40,000 employees. I have a couple of friends who work at Uber, but we'll see. At some point,
a lot of coordination, maybe.
How do you think early stage companies, super early, and I like to focus on the early parts of a journey, and I'm assuming most of my listeners are earlier in their journey. How should early founders think about product market fit? What signals should they use? Are there tools you recommend? Are there certain data points or metrics? And I know I'm generalizing a little, so feel free to use an example if that makes it easier. But how should an early founder think about this so they know the right points to make a pivot? They know when they're working on something that's probably not on the right path.
Yeah, so I've seen some recent analytics tools out there, and there was a great presentation at South by this year about using data to scale. And so I don't recall the specifics of that, but when I'm advising founders or talking about what's happening, we're looking at the different uses metrics. And I like to get founders to find a power user, if you will. And so if you can find somebody that's really leveraging your tool and is an expert at using your tool, then they're going to give you insights into the kind of value you're creating for them. And then you want to see, okay, is this something that I can spread across the market? And so if you don't have any power users, then to me, that says your solution doesn't really solve a problem in a strong way for anybody.
Makes sense.
And so that's probably the first step I encourage people to do is find the power users and then really engage with them deeply to figure out how to leverage what they're doing and how they're finding success with their product, and then build on that and look for more power users.
One thing I see some founders get not stuck on or straight on, but I talk to early customers that have power users. They want X, they want Y, they want this integration, they want that integration. And I've seen a lot of people get stuck in sort of that rabbit hole of, hey, these 5 people are paying me a decent amount of money. Let me just build everything they want.
Right.
How do you combat that? What's your advice?
Yeah, power users have to align with your vision, or else you're going to be, your innovators, because your innovators will tend to be your power users. And so you have to make sure that they align with where you want to go. Because if they don't, they're going to take you in a different direction, right? And adding features for the wrong customer is very troublesome, as you know, right? I mean, you can spend all your time adding features for a customer, and then you just create a very broad horizontal solution that doesn't really solve the problem in a unique way for anybody because you've got so many features.
Yeah. How does thinking about this change from early stage to I have decent revenue coming in, middle stage to more later stage, established company? How should a founder think about ensuring that they've sustained fit throughout. They've sustained the right momentum with the product, chose the right direction. How do you think about that?
So I think about it in the terms of what Steve Blank wrote in the 4 steps to the epiphany, right? So your first step is customer discovery, where you're looking at the problem and do I solve the problem for the customer? Your second step is customer validation. So now you're more directly focused on the customer, less focused on the product, but making sure that the customer is solving their problem in a way that's going to kind of create a sense of urgency or a need for them to, or a desire for them to pay for this product, right? And then, so I've confirmed that I can solve the problem. I've confirmed that a customer exists that needs this problem solved. Then your third step is customer creation. And so that's where you're identifying what's the best channel to get to this customer.
Got it.
And so the startups that I'm working with and advising, we're trying to get through customer creation before Series A, because we want to go to the Series A investors and say, hey, we know the problem, we have the solution, we know the customer, and we know how to get to that customer.
We just need to put fuel on the fire.
Right. And so we've tested whether it's a direct sale type effort or whether it's online with inbound marketing, outbound marketing. We've tested all of those, and we have metrics that say we've found the most cost efficient way to acquire customers. And now we're going to use your investment to go acquire as many customers as possible. We're not going to experiment. We're not experimenting with the product. We're not experimenting with finding the customer, and we're not experimenting with channels. I see too many startup pitches that for Series A, they want to spend money on testing 3 different marketing channels. And you can do that, but my approach is to go into Series A with the one marketing channel that works. And then, you continually test other channels, but I've got one channel that works that I can fall back on.
Yeah. And I think the goal there is also when you're raising a Series A, you don't have infinite runway. You need to efficiently use dollars. You need to know how to use them. You don't want to raise like a $2 million Series A, spend half of it figuring out where to put the money, and then you're like, oh, I don't have enough to acquire, because even if I spend all of this, I don't have enough revenue to be profitable. You're still burning, whatever, right? I do like that thinking of understanding where to spend, where to put fuel on the fire, and then go ahead.
Right. That turns your A into a growth round, which is ideal. It doesn't always happen, but that's ideal.
Yeah. Lately, I went to SF in Jan, met a lot of people. I constantly hear people, I'm raising a seed plus, I'm raising a pre-seed A, and I feel like it's just ways for people to structure rounds because they still haven't figured out what the product and solution is. And so you can't go raise a Series A to still test an idea because no one's really going to do that. So I just find it interesting that there's all these terms of rounds. There's so many. And at the core of it, I'm like, for me, it's like, I would consider everything like a seed or an angel round and then a Series A. Like, I would just do 2 buckets. Either you have a solution that works or you don't.
Yeah.
Everything else is just,
you either have this product market fit concept at some level or you don't.
Yeah.
And so you're seed until you have it and you're A plus after that.
Yeah. When do you think a company or a founder should start thinking about building a secondary product? And in my experience, a secondary product is either to increase LTV from a customer, decrease churn maybe, or maybe open up a slightly new customer base to, build a company. At what point does that make sense? And the reason I ask that is you said, hey, Series A, you're putting fuel on the fire. Okay, let's say I figured it out. I've got customers. I've gotten a decent percent of the market, but I still need to keep growing.
Yeah.
At what point does solution B come into the picture?
I mean, my encouragement on that would be, don't look at solution B until your growth rate on your primary product has slowed down.
Okay.
The typical SaaS growth rate is, was it 2x, 2x, 3x, 3x to get to 100 million.
Yeah.
I think that path to 100 million is so all in that if you're trying to add a second product, it's just not possible. Now, are you expanding features and going deeper into the customer solution? Yes. But as far as, do I need to have a second product because I think my sales of the first product are tailing off? It may be the case where your first product's not going to get to 100 million. You start to see it tail off, and now you want to bring in another product.
Yeah, makes sense. No, I like that. I also think it's very easy for teams and founders to get very distracted, right? Because I feel like this dynamic of I raise money, there's investor pressure, I got to show growth rate, and founders start believing, oh, the number matters more than my understanding of the problem, the solution, and knowing that, hey, I have a plan, I'm going to execute on the plan. Maybe instead of 24 months, it's going to take me 36 months. But I feel like the notion of investor pressure forces founders to make decisions like, oh, let me add another revenue stream. Let me do this tactic. Let me try another channel, because there's the pressure of like, hey, you got to show me like that in IRR, internal rate of return, or whatever.
And it's tough. I mean, a few years ago, there was a little company in Austin, and I went to they had the hired CEO, so it wasn't the founding CEO.
Yeah.
I think the founding CEO he'd actually been replaced by this hired CEO, and he was talking about how they were going after 3 markets in parallel, and he made the comparison that, I'm essentially building the plane as we're flying it. And the founder I was with at the time that we were working together, he said, see, I'm doing what we should be doing. Well, a couple years later, that CEO was out. The original founder was back, and they were down to 1 product. And then they eventually sold that 1 product to a large company. But I think you take on a lot of risk when you dilute the focus of your team by saying we're going to go after 3 markets. And I see startups do it all the time. This is not necessarily a right or a wrong way to do it. You just got to understand that 2 markets is not twice as hard. I mean, there's some multiplier effect in there to bring that complexity into a business that's not mature yet.
Yeah, 100%. When I was in SF in Jan, as part of the on deck cohort, someone was giving a talk. They said something similar like, hey, I really understand the space. I'm from this space. I am both CEO, CPO. Let me drive the solution home. The board was like, you should bring in a CPO. He's like, I know what I'm doing. Trust me.
Yeah. Pressured
him into hiring a CPO. Okay. Found a executive recruiting firm, paid them $120K, hired a CPO, paid the CPO like $350K. 3 months in, he went aboard. He's like, it's not working. We're not vibing. Doesn't work. His style doesn't work with me. I'm like, okay. They're like, you can give it a couple more months. Again, push him into this situation. He's like, okay. Comes back. He's like, it's not where. He's like, fine, you fire him. They delayed it so far that he lost a 6-month clawback with the recruiting firm. Oh. So they couldn't even hire him a new person.
Yeah.
He's like, $500,000 later, I'm in the same spot I was 6 months ago, just because I didn't trust my gut instinct. And that's why I was bringing this up of sometimes there's this notion of investor pressure versus I know what I'm doing. I know what's right. Let me trust my gut and keep doing it. And founders tend to sway on the side of, hey, you gave me the money. Let me say
it is hard. It's hard to push back on the people who gave you the money and say, yeah, I'm not going to do what you recommend.
Yeah. And the reason I bring that up is I wanted to segue into you co-founded Longview Tech Ventures, your GP there.
Yep.
I think you focus on earlier stage investments. What are 3 things you look for? Or it doesn't have to be 3. What are things you look for when a company comes to you and gives you a pitch?
That's a great question, because the original thesis for Longview Technology Ventures was that was back in 2018 when I was doing fractional CFO work. And so I was seeing a lot of opportunities to invest, if you will, as the last check in.
Got it.
And so that's kind of the ideal in a seed round.
Last check in a particular round.
Right. And so, the founders are raising $500K. You don't want to be the first check in because you don't know if they're going to get
the 450.
The 450 or whatever. And ideally, you want to be the last check in. And I didn't understand this concept at first because I actually heard some investors say that to us when I was at an exorcist. And they said, well, we like to be the last check in. And I thought, yeah, well, doesn't everybody? And then they said something that was interesting. They said, what we find is that sometimes founders will get ahead of their operating plan, will get ahead of their fundraising plan. And so, for instance, at Nexusys, we were trying to raise $5 million. We raised $2.5 million. And so we started executing our $5 million plan. And then
but you couldn't commit that.
We took the focus off of fundraising, which is dangerous. And so we weren't able to get the rest of the $2.5 million. And when you're executing on a $5 million plan, you only get $2.5 million. You run out of money quick.
Yeah.
And so one of the things that I look for is what's your runway?
Got it.
Because I've got to size that with my check. And so, for instance, if we write a check that's anywhere from $25,000 to $200,000. And so if I'm looking at this investment and saying, I want to write a $25K check and you're burning $200K a month, well, I don't even buy you a week.
Yeah.
Right. And so there's a mismatch between my investment intent and your need for runway. And so that's one thing. And then the other thing is I look at whether or not the entrepreneurs are solid on their vision and strategy, because I've seen some entrepreneurs that will kind of shift based on what they hear, not from the market, but from investors.
Okay. And
so if the message is changing based on their most recent conversation, then it's like, okay, I don't want to get in until you settle in on what your message, like,
makes sense.
I was meeting with this one founder. I was really excited about what they were doing. And it was our second meeting. And they came into the meeting and they said, oh, good news. We're now a data company.
Okay.
And I said,
it didn't start out as that.
What do you mean you're now a data company? Oh, well, we talked to our advisor who came from this industry and they're a data company. And really the big opportunity for us is to be to sell the data, because once we'll have a rich set of data once we get a bunch of users. And so we're focused now on being a data company. And I thought, that's not a good strategy when you don't have users. Because Facebook is a data company now, but they didn't start out as a data company. So
makes sense. Are there things you look at to underwrite a deal outside of intuition? You look at, hey, you're going to raise a round runway. Are there particular things you're looking for before you underwrite and put in a deal?
So I'm looking for what metrics are they tracking? What do they think is important? Because we are somewhat vertical agnostic.
Okay.
I'm looking for what interests they have from later stage founders. Kind of the ideal introduction is a Series A VC firm calls me up and says, hey, Jeff, we'd like you to look at this company. They're too early for us.
Got it.
But we're interested in what they're doing. We can't participate in this $500K round because it's too small. But if they can hit these certain metrics, then we'd be interested in leading their Series A. That's
a good signal.
It's a good signal. And also, I look at, what's their experience? Have they done it before? The fund started out as a first-time founder fund, which is tough. 10 years is short for a first-time founder fund, I'm finding. And what I learned is that there has to be somebody in the team that is not a first-time founder.
Got it.
And so then I look for, okay, how do you round out your team? What's the I look at the cap table to see, okay, what is the ownership of the other people on the cap table? Is it right? Is it aligned with what their value they're bringing?
And to clarify, when you say first-time founder fund, you're investing in first-time founders. Is it tough from a deal flow perspective, from an outcome perspective, or Tough in what regard?
Tough in a regard that first-time founders tend to take longer to get to where they need to go.
Yeah. A lot more figuring out to.
And I know other VCs in the Austin area that will not invest in first-time founders because they take an exit too early.
Yeah.
Because, I mean, who wouldn't? You start your first company and somebody offers you $10 million and you're the primary shareholder. Why not exit? And so I didn't see that as a challenge necessarily, but just, I mean, we structured our notes or safes with an anticipation that they may take an exit before it converts.
Okay.
And so there's certain terms in the safe notes that if you're not considering that scenario, your return could be really low if they don't convert before they exit. So we look at that.
Okay. Do you care about market size? Are you looking at any particular market size? Do you care about technology risk? Or because I think what you talk about is a lot of like founder execution. Do you look at those aspects? How much does that matter in terms of your decision overall?
I look at, do I believe this can be a public company?
Okay.
Because I think in the VC play, you've got to have line of sight to going public.
Yeah.
Now, you can exit prior to that, but to get the VC level returns, you need to be in the path to go public. And so there's some stuff that I see that, okay, you'd be better off bootstrapping this, or this is a lifestyle business, or I don't see the market opportunity. I mean, I teach entrepreneurship, so I'm a stickler for market sizing.
Yeah.
But it's a challenge to do that, but I often see it done wrong. And
are you a top-down market size person or bottom-up?
Both. I think it's got to be validated in both directions.
Okay. Any recommendations or tools or resources for just market sizing that you think are particularly helpful?
I think it's helpful to look at the unit economics of your business.
Okay.
And then really get clear on your ideal customer profile. Like, who has this problem? I hear so many founders say, well, everybody could use this, or it's only $3 a month. Everybody's going to add this app on their phone. And the truth is that doesn't happen.
It's funny you say that. I don't know who I was listening to, some podcast, and the guy said a lot of founders in New York and SF don't understand that most of America can't afford a Netflix subscription. And then when you're adding another subscription, they have to make a decision. Oh, do I want X? They have to find something to pop off their list to be able to afford your $10 a month subscription. And I think a lot of people who are like in the SF New York, like tech startup bubble, don't understand that, like you said, $5, $10, $20 a month subscription,
right?
A very small percentage of the American population is going to realistically sign up, afford, and stay a customer for the lifetime that you want them to stay a customer.
Right, because the people that are in those areas are in the top 1%,
100%
of earners.
Yeah.
Right? So they look at it and think, well, I'd spend $3 a month for this app.
Yeah.
300 million households in the United States. That's our market opportunity. So,
yeah. Every time I see an ad for an app, we're like, oh, connect us to your credit card and we'll tell you all your subscriptions that you don't have. And my first thought is, someone who has unwanted subscriptions is not the right customer for some people who are more cash out, budget friendly. They don't have unwanted subscriptions. So you're catering to a very small demographic. And then the top half of the market, they don't really care if there's a couple extra subscriptions here or there. They probably use them once in a while. It's too much effort to unsubscribe, resubscribe when they want it. You're catering to a very small market. So I'm very curious actually how many users are active and like use something like that because of the same numbers. Market that is. So you mentioned people get market sizing pretty wrong most of the time. Founders get them wrong
Right.
most of the time. Yeah.
Right. And the example I put in my book is, and I've heard this said by founders, hey, this is a $400 billion market opportunity because we are in enterprise software. And I think, yeah, but your software does not do every single thing that enterprise software does, right? Enterprise software is a very broad field, from CRM to probably project management to everything in between, right? And so to say that, well, we can our total available market is 400 billion is just incorrect. And that's an extreme example, but it kind of gives you a thought of, okay, where does this sizing data come from? I was early in my career, I was in a meeting with the marketing person who had told us, so I was in design engineering, and she was asking us to develop a chip for this customer because she said this is a $1 billion opportunity. And so I'm sitting there with my boss at the time, who's the VP of engineering, and he's asking questions of this customer. Okay, you guys do $1 billion in this industry. How much of that is services? And the customer said, oh, that's about 80% is services. Okay, and what's the next 20%? And he broke down the 20%, and it turned out that the market opportunity for our part with this customer was maybe 100K. And so, you walk into the meeting and the marketing person is saying, this customer meeting we're having right now, you guys, this is $1 billion opportunity. And we walk out, and my boss had kind of whittled it down to 100K opportunity. And that totally changes what you're willing to invest 100%. In a product if you really understand how the customer's going to use it, how many they're going to buy. You can't just look at the financial statements or the investor report and say, oh, these guys do $1 billion in this industry. If we're doing a chip for that industry, then it's $1 billion opportunity. So
makes sense. On the VC side, what was one thing that just startled you getting into VC and investing that you were unaware of, being on the other side, trying to raise, being part of startups and companies, being an advisor to companies?
The LP interface. So, VC funds have limited partners, and we raise capital.
Yeah.
I have to go to my investors and say, this is what I'm going to do. This is why you should give me money.
Yeah.
And you want to stick to that thesis because that's what your investors gave you money for. And so that was a surprise to me to think about it in those terms and think, okay, I think this opportunity is really exciting, but it's in Northern Virginia. And when I told my investors we were doing a technology fund in Central Texas, I said that was one of the selling points. We're investing in Central Texas. And so I had to think through, okay, is this opportunity in Northern Virginia so compelling that I'm willing to go to my investors in an update or whatever and say, oh, by the way, we made an investment in Northern Virginia. And so that's a surprise. And I think a lot of founders don't really realize that, right? And I see it all the time because I'll tell them, well, we invest in Central Texas. And they say, well, we have an employee in Central Texas. And I'm like, well, but your company's not in Central Texas. Your company's in Southern California or whatever.
Yeah.
And they'll try to kind of shift the narrative of what they're saying to match your investment thesis. And it's like, I can't shift my thesis because that's what I committed to my LPs I'm going to invest on.
Yeah.
And I want to stay true to that thesis. And it doesn't really fit with what you're doing. We don't invest in medical, and we don't, because we don't understand. I certainly don't invest in crypto. I have very conservative investors in Longview, Texas and Midland. And so they're not the crypto crowd. And so to send out an investor update and say, yeah, we've got investment in crypto, that'd be crazy.
So this is just more my personal curiosity. How difficult is it to raise a fund from LPs? I've never raised. so I don't relate. But I'm just genuinely very curious. It's very different when you're raising a fund, because you're going saying, hey, I'm raising an X $1 million fund. Here's my thesis, blah, 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 whatever, carry generic terms. How are those conversations? How difficult is that? Especially if you've never done it before.
They're very difficult if you've never done it before. They get easier if you've got a track record. I mean, I get a lot of questions from people that want to do their first time fund, and I have strategies for how to do that now that I've done it. And it essentially includes not doing a first time fund, but kind of creating a fund of angel investments that you've made, and then rolling that in, calling that fund one, and now you're going out to kind of
Fund two.
The other, so you can do that by syndicating deals, whether you're investing with friends or whatever, or you can do that as an advisor. There's some local accelerators where I was recommending, hey, just take all of these accelerator advisor shares, roll it into a single
Fund
entity,
one,
and call that fund one. So you always want to raise fund two. The first time fund is harder if you haven't had a successful exit. So a successful exit could be as an entrepreneur or as a angel investor. And so limited partners want something that they can hang their hat on, or that you can hang your hat on and say, I've done it
Sort of
successfully in the past.
right? Sort of a stamp of approval.
Yes.
Makes sense. Maybe this is just the product side of my brain. When he said roll everything into fund one and raise a fund two, and I'm like, that just feels like optics. Because every time you look at like a product update or an internal deck, you're like, we have 10 million ARR. But I'm like, okay, if you break that down, it's really like 6 because you rolled in the credits we gave out because that's theoretical. And like, it just feels like optics in terms of how you position the language. I'm not saying it's necessarily a bad thing to do, but I understand that it's basically telling LPs that, hey, I know what I'm doing. I've done this before. I understand this space. So I'm not just winging it. I'm not just going to, throw a dart.
Right.
Whether that's in the optics of like a fund one, fund two, whether that's credibility, stamp of approval. I understand why it's done. I just always go back to every time I'm seeing internal product updates at a company, I'm like, well, I know these numbers are like made to look nice, but if you really want to break it down, like your $1 billion to 100K example, they don't look this nice, but you got to make them look nice, right? So
and I think the taking kind of some angel investments that you've made or some advisor shares that you have and rolling that into a fund shows your kind of ability to identify opportunities, and also gives you somewhat of a track record and a model to communicate to the VCs. One of the things I struggled with in our first time fund was that we were raising from real estate investors, and they had no experience in venture. And so their big question was, well, when do distributions start? And it's like, well, when
7 years,
when we have an exit. And they're like, well, can we get quarterly distributions? I mean, no, we have to wait. And I still have that conversation with them today. But if I had a kind of a fund one where I could show, okay, I made this angel investment on this date and it exited on this date, and this was what the result was, that would help communicate, this is, I'm just going to do this again with more money. And so that's why I think it works. It's a little better than kind of the analogy of calling all revenue product revenue. So
makes sense. Being a VC on the other side, do you have a recommendation on how to reach out to VCs and how to find the right VCs to reach out to? My thesis here is I always recommend founders take a check from someone who's a good investor for their company and not just take any check. Now, it's easy for me to say that from a place where I don't need to raise a check. And I understand that when you're raising, you sort of take whatever check you can get because maybe you need the cash. What's your advice on finding VCs and reaching out to the ones who you think are really good fits?
So I think the best way to do it is to do research to find out who's in your segment, in your sector, who's investing in either fintech or SaaS or, whatever you do in health tech. And then look for those investors and then look to see if you've got any common connections.
Got it.
But also look at, have they made investments in a competitor?
Okay.
Because sometimes either they've made investments in a competitor or they've made an investment in something similar to what you're doing and it didn't work out. Chances are they're not going to
do it again.
And so there are a lot of databases out there. I'm looking at some now for private equity and venture capital. And when you look at the price tag and you think, wow, that's a lot of money. Actually, I honestly don't know what the price of PitchBook is now, but back in the day, we looked at that and said, that's a lot of money. I don't think we can afford that. But I think
I want to say $30K a year.
Yeah, it would have saved us a few months because there's a lot of family offices, angel groups, smaller VCs. But one of the things I coach founders with right now is, okay, you've got existing investors. You've got maybe 20 investors on your cap table. Call those investors and ask them, is there anybody in your network that I should be talking to? And most of them will say no, but some of them do invest in groups, and that's who you're looking for.
Makes sense.
Because the ones that invest in groups will say, oh there's 3 of my friends. We just went in on a real estate deal together. You should talk to, let me make an introduction.
Yeah.
Because they want you to be successful. And I think a lot of them, if they're not investing with friends, if they're just kind of out there on their own and figuring out on their own, they're not going to be good referrals anyway.
Makes sense.
But you've got to ask that question because you don't know who's going to be a good referral, who's not going to be a good referral, who has a network, who doesn't have a network. And you also have to consider that some of the people that you talk to, some of the people that you're asking for referrals are not in the, if you will, the mind share of that investor, right? And what I mean by mind share is that, okay, let's say I have a family office and I get an intro from John Smith. I don't look to John Smith for investment advice in any way. And so I'm probably not interested in that intro.
Yeah.
But if you know a founder of a portfolio company that I've already invested in, so you go through LinkedIn and you say, hey, I want to talk to Jeff. And you look at, okay, who do I know that knows Jeff? Let me go to Jeff's website and see what companies has he invested in. Okay, I'm connected to the founder in one of these companies. That's who you want to ask for an intro.
Yeah. Third time I've gotten that advice on this podcast, but just honing down on that.
So it's tough. It is tough because I get a lot of cold emails and DMs on.
How many do you take a look at?
So because I teach entrepreneurship, I look at most of the pitch decks I get.
Okay.
Because I'm always looking for examples of
good and bad ones.
Good and bad, teaching examples.
Yeah.
But I would say I don't look at any cold ones right now.
From an investment point.
From an investment standpoint.
Makes sense.
But we're 5 years into the fund right now. And so I can't make a early stage investment. Because you got to figure I've got 5 years to the end of my fund.
Yeah.
And so now I am actually reaching out to my connections in the later stage funds and saying, hey, if you do an A or a B,
let me know.
That has some room, let me know.
Okay. And
so those are the referrals I'm getting, and those are the ones that I'm following up on, as opposed to, I've got this new technology and I'm raising $750K. It's my first round. I can't do those anymore.
Yeah. So I think we talked about how to reach out, how to connect, how to get good intros. One thing that I think founders don't stress upon and again, this is an opinion from a point of view of just working with founders, not having raised, just for context.
Okay.
A lot of founders think that VCs drive the dynamic of the relationship, versus I feel like founders should always try to find the VC that thinks the same way they think, excuse me, understands their approach, their thinking, understands their risk-taking ability, their product building mindset. I feel like if you're not a match on that level, every conversation you have for advice or mentorship from that VC, if you take a check, is going to end up in some sort of argument or discussion where VC saying do X, you're like, no, I'm going to do Y, and like you never come to common ground.
Yeah.
How important do you think that is? Do you focus on that? Do you ask certain questions? And how can a founder look out for those things? So sort of a loaded question, but feel free to answer however.
Yeah, I focus on that more now after making like, I think 11 investments and seeing, some founders are interested in what I have to say and some are not.
Yeah.
And I think it goes both ways. I think, like you said, you want to find the investor that you connect with, and think about it as a mentor-mentee relationship.
Yeah.
I'll use this example that I heard from one of my MBA professors. He said, he told a story of he decided he wanted a certain person to be his mentor. And he met with the mentor, and the mentor said, I want you to do X, Y, and Z. And he's like, well, I don't mind doing X and Y, but I don't want to do Z. And he's like, no, I think you ought to do Z. And so at that point, he had a decision to make. Either I'm going to do Z and trust this mentor, or I'm going to go find another mentor. And so I take that lesson into kind of the investor relationship, right? If you're talking to the investor and they're giving you pushback about what you're doing and you don't like that pushback, don't take money from them, right? And if you guys aren't, guys, gals, let's be gender neutral here. If you're not connected on the strategy and you're very firm on this is the strategy that I want to take, then you're better off, as you said, right? You're better off going to another investor and finding somebody with alignment. And it's a hard thing to do because when you're a founder raising capital, and I've been in that kind of the supporting role of, working with multiple CEOs raising capital, you think that this meeting, this is, I know how much is in the checking account. This one's got to work. Let's just
take it.
I know this, it didn't seem like we didn't connect on a few issues, but we really need the money. And those are usually the mistakes because you've got somebody on your cap table that is not aligned with where you want to go.
That's when you sign like a 4X preference term sheet and get screwed out of whatever exit. But
well, 4X preferences are bad in general. So
what's been your most awkward interaction or pitch with a founder? And I say this because I was at a South by VC
and you're putting
thing.
me on the spot.
I was at a South by VC thing, and a VC got pitched right next to a urinal, and one of my friends saw it, and he was like, "This is not the time or the place." But have there been just an instance where you're like, not the best time to pitch me, but it's been sort of
there? Yeah. So when I was new to having a small fund, and I started going to these events to try to meet founders. And there's some events where they'll put different color stickers on your name tag,
like
right?
investor founder. Yeah.
And I remember being at one event where, there was a very, very eager founder. He saw my little investor color name tag thing. he went into his pitch, and it was the right place for that pitch. But I said, well, we don't do med tech or whatever.
Yeah.
You know, we're focused more on this. So then he shifted his pitch to tell me how, oh, well, we're not really med tech, we're this, which was what I just told him we invest in. And I'm like, and he wouldn't let it go. I mean, he was insistent. And I think for a couple months after that, I avoided those kind of meetings. Or if I went to a meeting like that, I didn't put the investor sticker on my name tag, because I was like, I don't. And I think you see that in the industry, in the networking groups around Austin. You don't get principals from the VC
analysts.
firms.
You get analysts.
You get the analysts. You get the entry level people, and that makes sense to some extent. But even, you know, I've seen they're not even, some of the GPs in the local funds aren't even on panels anymore. I mean, they're sending like their analysts that are like 2 years out of school and go do this panel for me. And so I think because of that, because these networking events have been such a kind of confrontational is maybe a strong word, but you know, you get founders that just, once they get you in their circle, they won't let go. And they're maniacally focused on, I've got to pitch you my thing, and I've got to tell you what and why you need to invest. And I can't believe you're not interested in hearing my pitch. And it's like, I'm here to meet a lot of people, and just,
I'm not even going to remember this.
Mm-hmm.
Why waste your time? Yeah.
And so fortunately, I don't have any situation where I was pitched in next to a urinal, but I mean, that's one that comes to mind, where I remember where I was in the event, and that was the last time I went to that event. And
the reason I ask is I run a service firm, software services, right? So I never once mention I do that. It's something I do. I have an agency. Great. I will never say that, because I've noticed that folks in Austin, not even anywhere, the second you say I have an agency, they'll automatically associate all these connotations with what I'm going to do. They're like, okay, you're going to sell me, you're going to do this.
Yeah.
I'm like, I have no interest in telling you about you asked me what I do, so I told you. I have this podcast now, so I'm like, hey, I'm a podcast host. I don't even say I have an agency anymore.
Yeah.
And it's just that connotation of, people associate agency owner with, hey, he's going to obsessively sell me whatever service he has and find a way to fit it in. And I think same thing happens in like investor founder meetups, where everyone's there like, I got to pitch you. And my take is, these places are more to make the connection and sort of convert your cold intro into a warm intro. Get their email, get their number, whatever.
Right.
And follow up and be like, hey, I had a great conversation. I'd love to tell you about my thing XYZ. And if they're interested, they will reply. If they didn't have a good conversation, then they will not reply, at which point it doesn't even matter whether you pitch them that day or you send them a cold DM, you're at the same place. Your job there is to leave a good first impression. It could matter less. That's my personal take. I don't know if you agree or disagree, but
I think you want to do the elevator pitch. I think you want to spend 30 seconds just seeing if there's interest.
Yeah.
You know, touching on a few of the high points and there's great programs around town for doing that. I've heard of a program in Boston, and I think they ought to do it at Capital Factory, where they actually will put mentors on the elevator, and you go into the elevator, and as it rides up to the floor, you get your 30 seconds to pitch, and then the mentor stays on, the entrepreneur gets off, a new entrepreneur gets on, and they have 30 seconds down.
Interesting.
And so I think that would be fun, but you're not going to get a check in that meeting.
Yeah.
Your goal is to make the connection, to plant the seed. And if they're interested, they'll tell you, but you got to understand that 99, maybe that's a little high, but 90% of the people you talk to are, your startup is not going to align with their thesis.
Yeah. 100%.
Or your personality is not going to, or they're in a different place, or, you know, whatever. They may be in the middle of fundraising and not actively investing. Because, you know, the bigger funds, they go through cycles, right? Every 2 years, they're out back to market, and they may be out, you know, networking to stay active in the community, but maybe not actively writing checks.
Yeah. And this is not advice for anyone listening. I personally, if I'm going to go build my startup, I would not raise until I have an idea, I know it works, and I need fuel to put on the fire.
Yeah.
I've built enough product. I know the true cost of development. I feel like I'm technical and product enough where there are enough tools available nowadays where if you're motivated enough and you truly believe in the idea, you can get a very good minimum viable product out in market, test it, and fail for 5 to 10 grand.
Yeah.
And that's also pushing it if you don't want it to look good. And I fundamentally believe that if you're raising a pre-seed round for exploration, of like, I have an idea, let me go figure out what the solution is, you're doing it from a point of privilege of you've exited twice before, you have the ability to go raise $1 million round on your, I don't know what to call it, like
your credentials.
Yeah, credentials. And that's again a place of privilege. For first-time founders, I fundamentally believe if you're motivated enough, you don't need a lot of capital to go and try your idea. There's enough resources, tools, no code, AI. You can grind it out, do your job, work at night, part of being an entrepreneur. Because once you take a check for someone, outside of the pressure, you also have a fiduciary responsibility to do the best you can.
Yeah.
If you raise a check, it doesn't mean, oh, I can just chill and like, take it slow. And I feel like you don't need to put yourself in that position in today's world. Like, you don't need that to validate it. You can get much later. You can get much better terms. You can truly understand, what do I need money for? Why do I need to raise? Again, my opinion. And I'm not saying that.
Yeah, that's certainly true in software. Yeah. But I mean, there are some industries where
100%.
I do need some money. And I would say that there's a level of privilege in different industries and different things, right? And sometimes when you're reading that this second-time founder raised a $5 million round, he or she may have put $4 million in.
Yeah.
Right. And they may have said, I'm going to fund my company. And 3 of their friends said, hey, I want in. And so they're like, okay, well, I'll let you put in $200K or $400K or whatever. And so that's kind of what I see when they're multiple stage founders.
Yeah.
I don't see a lot of second or third time founders not putting their own money in.
100%.
But they do want external validation. So they do want somebody else to write a check, because that does say, okay, you're not just deluding yourself and thinking that this is a market. I actually agree with you, and I'm willing to put my money.
Also, I think it's very contextual. It's lower risk, right? Like, if you only had a $10 million exit, 10 million is a lot, but if you're going to put 2 million in a company, that's a big chunk of like your net worth, right?
Yeah.
And so it's also a lot of context here, but again, we'll cut it up to say that everything I said, if you're building in SaaS, I would SaaS do the bootstrap. Yeah. SaaS. No, I agree that there are spaces where you need cash to like prototype medtech hardware. That I agree with. Caveat with everything I said was SaaS.
But I agree. SaaS is a different thing, because you can, and so my son's a developer, and I always had this, I would keep pitching him ideas, because he was a computer science student at UT, and all his roommates were computer science. I'm thinking, right there, that's like if I can find the right idea, there's a hackathon in that apartment, and we could get a product out in 24 hours or something. But I never, during that time when he was in college, I couldn't convince him of the right idea. And so I kind of missed out on that opportunity. But I do think that there's, if you're not a coder and you think, well, I want to do a product, there's 2 ways to do a product, right? Is to find a co-founder who is a coder, or to take out a second mortgage on your house and pay $30,000 to a development team to put together a product. And I would recommend you find a co-founder who's
100%.
a coder and have them, hack together a minimum viable product that you can start testing in the market. But oftentimes and that's discouraging. And we've talked about that is to know that, when they come in and they're pitching me to raise $1 million or whatever, and they say, well, we've spent $80,000 of our money developing this product. And I'm looking at it thinking,
it's pretty shit.
You probably shouldn't have done that.
Yeah. And I think it also comes from a point of view of people just don't understand. And like, even at my firm, folks come to me with, I want to build this. And there's so much scope creep that happens because they'll go down a path and be like, I don't like that. Let's go here. I'm like, I can't just build you a new page. I got to build you new endpoints, new database table to store the data you want to store. It's not just a spin up a new page and do that. I think people don't understand. So I go through this whole scoping phase of like, hey, we're just going to work in Figma until we're aligned. Once you're aligned, I give you timeline and I start building. If you want to change anything, it goes through a full process. Like, because then you're not happy. I'm frustrated that you're giving me shit about timelines because you changed the scope 18 times. And I'm trying to get better and strict about that. I understand pivots are needed.
Yeah.
I only ask you understand that it takes time to pivot. Like I can't just go 180 and like do it in a day because everything's built. I'm like, it's not built. But anyways.
Right. And it's a little different if you've got a developer on staff that can, I'll stay up all night doing that kind of thing versus,
100%.
Let me call Hobby and redirect the team.
Yeah. Sweet. I like ending every interview with a couple questions. So, what you've had an extensive career. You have a fund, fractional CFO. You're doing a lot of things, writing books. Do you have a support system, and what's been your support system throughout your journey? Whether professional entrepreneurship, investing, have you had what would you say is your support system?
I would say that for most of my career, I did not have a support system, and that was a big mistake. And so I think since, I'll tell you, this is funny. My wife will laugh at this. So in 2019, when I went full-time at Longview Equity, she said, I want you to keep this job. You have a coach. You've got if you need an executive coach, I found one for you. You have a call with her on Thursday at 2:00. And so you don't have to hire her, but you need to hire somebody. Yeah. And so I've been with that executive coach since 2019, and that's my support system now.
Nice.
A big part of it. And I would say that, my wife has been a big supporter. It's been ups and downs of any marriage. We have 4 kids, and so that can be a challenge. We were in Silicon Valley in the 90s when our kids were young, and I love to work. And so missed out on a lot of things, but now there's more. I go through phases of doing, different exercise routines, different diet routines, different meditation routines, and I'm experimenting. I'm back to a certain exercise routine now that I think is going to work. I'm going to add the cold plunge in next week and experiment with that, see what that does. But I'm finding what works for me. And I think early in my career, I just focused on work. I didn't really care about,
life, relationships,
taking care of myself, taking care of my health, relationships or anything like that. And so I missed out on a lot, and that's all probably been corrected since 2019. I started working with an executive coach, and they help you understand your priorities and then live your priorities.
Someone you want to plug or no? The coach.
Alicia Marie. I don't think she's taken any more clients.
That's fine.
So.
We'll still link them if we we'll get that from you later.
She's the best coach, but maybe not the best for everybody.
Yeah. And I think it's same as finding a mentor. You gotta, I don't like using the word like you gotta vibe with them, but that's the best way I can explain of how to find someone to work with you and help you. You just gotta have the right vibe with them. Outside of principles and thinking, but I would sum it up as vibe. I don't know if that's the best word.
Right. No, I think that's a good word. I mean, it's funny. So my wife is a coach. And so, I pushed when she said, I've scheduled you a call on Thursday with your executive coach. I said, well, why can't you coach me? And she's like, no, I can't coach you. I'm not going to coach you.
Yeah.
Because there's different personalities require different kind of coaches. And 100%. So, I encourage the founders that I work with to get an executive coach. And in fact, there's an executive coach character in the book that kind of walks the founder through just the realization that he wasn't following lean startup. He thought he was.
Yeah.
He was using a few buzzwords and thought that, the few demos that he had booked meant that he had product market fit to the level that he understood product market fit. And so, so part of his journey to getting things back on track involves two coaches. One is an executive coach who actually is an executive coach, and then a product market fit coach. And that's where I think you have to be careful is the product market fit coach is not really a coach. It's a consultant.
Yeah.
But in the book. And so there are consultants out there who call themselves coaches. Like they're a CEO consultant, but they'll call themselves a CEO coach. And they're not doing the same thing that an executive coach would do. And 100%. So you have to be aware of that. And they both have a place, but you have to know going into it. Because I think that you may have some expectations. Certainly if you've been with an executive coach before and you switch over to this other CEO coach and you think they're going to be the same way, and you find out, well, they're trying to tell me what to do, and I don't want my coach to tell me what to do. And
yeah,
it's a very different experience. And so there's two coaching characters in my book. And one of my early reviewers said, what is this? It's a book about coaching? It's a coach's book? What's this all about? And I was like, well, the product market fit coach is really a consultant. So, but that doesn't roll off the tongue like product market fit coach.
Makes sense. What are 3 resources that you would recommend to listeners? And I know you brought some.
I brought my 3 favorite books because I knew you were going to ask me this question. So this is the first one is The War of Art. And so I've read this thing multiple times, and it's pretty short. I mean, each page is a little short thing of what causes. So The War of Art is about breaking through creative barriers.
Okay.
And so I wanted to write a book. And so like I've read this multiple times to try to
get through the
psych myself up. I've read draft number 4 by McPhee. I've read Bird by Bird by Lamont. And I kept looking for, okay, what do I need to do? But this one was
nice.
My favorite as far as kind of thinking through, because he has different examples of resistance.
Nice.
And I mean, there was one in here that I just read it and it just like pissed me off. I was like, done with that book. My second favorite book is The Mom Test.
Heard a lot about this. It's on my list. Haven't read this yet, but I know the gist of it.
So yeah, this is a great book, and I it's on my list of startup resources in my book. So Rob Fitzpatrick is a software engineer. And so what he learned, and what I hear a lot of entrepreneurs do, is so he was going out and talking to customers, and what he found was that everybody told him his product was great and nobody would buy it. He's like, well, it doesn't make sense. Why is everybody telling me how great my product is, but nobody wants to buy it? And so he realized that when he was doing these customer interviews, he was spending all his time talking about the product and not really learning about the customer. And so as a result of that, he put together this guidelines of how do you ask questions of the customer in a way that even your mom couldn't lie to you.
Yeah.
And then this is my favorite book of all time, The Innovator's Solution. Have you heard of this one?
No, I have not.
So this is from the 90s, which is maybe why you haven't heard of this. And I have not read this. So this is Clayton Christopher. And so Christensen, Clayton Christensen. Clayton Christopher is our local celebrity. So Clayton Christensen. And so he's written multiple books, The Innovator's Dilemma, The Innovator's Solution.
Okay, I think, yeah, I've heard of them. Yes, I haven't read them. I've heard of Innovator's Dilemma.
Yeah. And so that's a great book as well. But I like this one because it so The Innovator's Dilemma raises all these issues, and then this one addresses it.
Got it.
And so that's
nice.
I think I probably read this in the early 2000s, and this was instrumental in my thinking about, how do I shift kind of what I'm doing from the engineering side to more marketing and enterprise focus.
Nice. I like it. And the last thing, I do the segment where I ask every guest question for a future guest.
Okay.
And so your question, how do you keep your business a passion rather than a noose around your neck? How do you find balance?
Man, how do I keep it a passion? So what I've been doing recently is looking at, okay, what
makes you happy?
Well, I do both. So what did I not enjoy this week?
Okay.
And what did I enjoy? And how do I shift kind of my consulting work so that I'm doing more of what I enjoy versus what I don't enjoy?
Makes sense.
And I think in the past, so I started doing fractional CFO work in 2014. In the past, I would have been like, everybody that asks for help, I'll help them. But now I'm starting to turn away clients because it's like, I don't see alignment.
Too early, too late, expecting the wrong thing.
Or, it's like one of the questions I got recently was, okay, well, if I were to bring you on full time as a CFO, what would you do? And I'm like, well, here's the 3 things I would do first. And he's like, well, I don't think that's what we need to do. Okay, then you don't need to bring me on as a CFO.
Yeah, makes sense.
And so it's that I think is that I'm going to go with that as my answer.
I like it.
I meet with my my business partner once a week, and we go over, okay, what worked, what didn't work last week, and then we kind of shift.
Makes sense.
Because part of it is shifting the message of, okay, are we going to, if you didn't enjoy doing that project and that product line is on the website, should we take it off? And it's like, yeah, we should probably take that off because I don't want to do any more of those projects. Or I need to hire somebody to do that part of the project.
Makes sense.
So kind of we're looking at the balances there. But I would say that's a big thing I've been doing this time around that keep it from being a noose around my neck.
What's your question for a future guest?
My question for a future guest is, what has been the most influential teacher or professor in your life and why?
Okay. I like it.
It could be grade school, could be high school, could be college.
I like it. Very different from what we've had so far. So yeah, I like it.
It's not as entrepreneurial as your other questions.
But no, great conversation. Thank you for coming on. I appreciate your time. Where can readers find you? What do you want to plug? Where can they reach out? And we'll link everything in show notes and description.
So I'm really active on LinkedIn. That's the best place to reach me. You can get my book on Amazon. I've got book number 2 in process.
Nice.
And so I'm really excited about book number 2.
Nice.
It's a very different, it's still on the leadership fable genre, if you will, but it's a very different story, and the initial feedback has been really good.
I like it. Cool. But yeah, we'll link everything. I appreciate your time. Thank you for coming on, and we'll get you on for episode 2 in a couple months and talk about book number 2.
Awesome.
Sounds good. Thank you. Thank you for coming on, Jeff.